Welcome to ACY Securities. I'm Ira Reyes, macroeconomic strategist. So today, the inflation is making a comeback as a major worldwide concern. And tonight, we are going to have the data from the core CPI from the United States and for the month over month and the year on year for the inflation rate. And at the same time, we are also waiting for the interest rate decision from the Bank of Canada. So how will this make an impact across the financial markets during this mid-year period? And is it all about energy costs or other variables incorporated into it? Just a reminder, this represents my personal view of market movements and does not constitute investment advice. The trading involves a high degree of risk. Please ensure you have a solid risk management strategy in place. My strategic analysis is I utilize a dual-layered approach that synthesizes macro-level catalysts with technical precision. By cross-referencing fundamental shifts against statistical trends, I execute high-conviction trades where market sentiment meets optimized expectancy. So before we start, please don't forget to like, share, and subscribe to our channel. And for further information about in-depth analysis, you can join our discussion on our Discord, and the link is on the description box below. So let's begin with our economic calendar for today. So here we have the inflation rate from China, and it was already provided earlier. It's 1.3%. The actual, 1.2% is the actual, and the forecast was 1.3%. So it remains unchanged from that previous. And we have the inflation rate from the United States. So we can see here, it's a month over month. It would expect to downgrade on 0.3 from 0.4. And at the same time, the inflation rate on year over year, here it's going to increase. And for the interest rate decision from Canada, will it remain unchanged at 2.25%? So let's begin first with Canada. So here, here's the performance of Canadian dollar over the greenback. And we also have news from it. So let me check Canada. So what do you expect? So it says that the Bank of Canada is really expected to maintain their interest rate at 2.25 and during the 10th meeting, and which will be tonight. So policymakers, they balance the effects of technical recession against energy-driven inflation. And while some markets segments continue right now to have a price in potential hikes due to elevated energy prices, so the markets and then some, they generally view this economic climate as weak to justify an increase. First of all, why? It's because they are a petrocurrency. So moving forward from that, so some believe that the central bank will remain in a holding pattern, which means there is a stronger likelihood right now that future rate cuts rather than hikes should economic growth continue to struggle. Because for this one, investors already expect that the Bank of Canada to keep interest rates the same. So when you trade on the Forex, on the USD CAD, that news won't be a surprise anymore. Again, they have already, it's just a confirmation. So the currency flow, so when you look at this pair, USD CAD, like what happened last time. So this one is 2.25. So as we anticipate that 2.25, what do we see on the currency market? It likely won't move much right away. Instead, reacting to the decision itself, the markets right now will focus on what the bank says about the future and other economic factors like the oil prices. Again, they are also sensitive to the energy prices because they are petrocurrency. So that's how when you trade, when it comes to these high impact market movers like interest rates and at the same time inflation, you look on a lower time frame And once you have confirmed it's the same figure or data that is released, most of it, it's just a confirmation. So the markets, they have already factored in. So if higher than the rate provided, for example, it's 2.25 going to another 2.75 and so on. So here, USD CAD, it drops because, again, the interest rate is usually supporting the local currency. Since this one is pegged in US dollar, so because here, the math here is that the USD CAD, it represents how many Canadian dollars it takes to buy just one US dollar. So the Canadian dollar right now, it becomes more valuable because of the interest rate hike, and it takes fewer Canadian dollars to buy a US dollar. Therefore, the USD CAD, it goes down. So that's how we look when we anticipate interest rate hikes. And at the same time, let's take a look the performance of their interest rate over the past quarters. So you can see it's very consistent. There is no noise, or there is no what's this, outlier when you look on the historical from the mid-year of last year, so year on year. So here from June last year, 2.75 to 25 until it became consistent. So here, that's why you see the performance as well. It also became consistent because of the forecast and actual. It really matches at the same time. So when to give you update as well for the currencies, what is going on for the US dollar index, you can see here on the chart. So it went again to this 100 level, and right now it's between 99 and 98 level. So the dollar index right now is really holding steady, and because of the renewed conflict in the Middle East and rising energy prices, and it fuels global inflation concerns. Again, it's global, not just specific region. And investors right now, they are really keep eyeing or monitoring this upcoming US inflation data just to have a metric or gauge likelihood of what the Fed rate likelihood of a Fed rate hike before the end of the year. So because why we are talking about the end of the year, we are already on the second quarter. And if you are looking, for example, in the stocks, we are on the second half of the reports. So we are targeting right now the valuation that will be provided over the next coming days, or over the next few weeks to come as well. And at the same time, let's take a look as well what happened to the yen. So the yen also, it remains near multi-year lows, putting the significant pressure of the BOJ to implement further interest rate increases. And also, to update for the Australian dollar, it is really struggling at a 9-week low. So the RBA, it signals right now a continued focus on curbing the inflation or fighting inflation despite current economic pressures. And let's take a look what happened to the equities. So the global markets right now, you can see the performance of what happened yesterday, except for the Dow Jones. The global markets, they had, again, a volatility this week, and there is a sharp rotation out of the tech stocks. And it led to widespread sell-offs across the US, Europe, and Asia as well. So this downturn, it was compounded by, again, it's really the tension, and at the same time, we are on the focal of the inflation pressures. And on top of that, we also have concerns about the future interest rate hikes. That's why you will see from time to time, is there gonna be, will this be longer, or will they increase over the next coming meetings? So that's already the direct assessment when you listen to the interest rate hikes as well. It's not just for at this period or for this quarter, but rather throughout the year, because we are on the mid-year reports. And in contrast to this one, so we also have this Australian index as well, it backed already the bearish sentiment. And at the same time, we also have a rising of around 0.6% due to strong performance in its retail, logistics, and the utility sectors. And investors globally, they now face uncertainty as they evaluate the stability of these recent market rallies against the backdrop of growing international instability. And let's take a look as well what happened to the commodities. So here, the gold and silver, here's the prices. So gold and silver, they have reached their lowest level since late March. And investors right now move away from these precious metals and during these rising inflationary pressures, and there is really an increasing oil cost. Markets right now, they are on the side of being further fueled again because on and off in the Middle East tension and strong employment data. Again, it's a big catalyst right now, and it suggests that the Fed may soon increase interest rates. And as a result for this one, despite there's a brief retreat in the oil prices that you can really see, it's really dropping right now to this level. So lower levels right now. There are concerns also over the tightening of the monetary policy and global economic stability that really continues to create right now significant market uncertainty. And just again, to remind, what the markets does not really like is uncertainty. Because if you are doing on the valuation side, projecting the stock prices, projecting all this throughout the year, when it comes to market uncertainty, you are going to incorporate more and more variables when you are doing these projections or forecasts. Now let's go to the news. So speaking of energy cost, so here, just to summarize this one, for last April, so the US already, they had a trade deficit. It narrowed because of the exports of petroleum and the capital goods. It reached record highs. Now, there is a strong demand for AI-related equipment, and it also contributed right now to a significant increase in the capital goods imports. Overall, this trend right now, it suggests there's a potential strong or boost for the US economic growth in the second quarter. That's what we are all rooting for. And let's take a look as well from the high prices on the gasoline. So again, looking by the title itself, higher gasoline prices likely push the US consumer inflation again in May. So US consumer inflation is really expected to have reached its highest annual level since April 2023 because it's going to be on the around 4%. And so this since 2023 right now, it's really a big jump, and it is really driven by a sharp increase in energy and gasoline prices. And this consistent increase is really in the cost of living is outpacing wage growth, creating financial pressure for the households and also a potential challenge for the entire economy. Meaning, as a result for this one, these rising figures provide right now the support for the Fed to maintain these current interest rates as they continue to monitor the impact of the conflict in the Middle East. Since because we don't have resolution yet from the Middle East, at the same time, we are really tracking the inventories of the oil plus the supply that is being provided by the OPEC as well from time to time. Next, to give update from the Euro area, here the German industry. So the German industrial production, so it rose to 0.4% and marking its first increase since the start of the war in Iran. And it signals right now a resilience in the European area. And of course, Germany is the largest economy in the Eurozone. So this growth right now, it is driven by the construction sector. That means even the German economy ministry it cautioned already that activity remains subdued due to high energy costs and supply chain tensions. So despite there is an uptick for those two catalysts that right now, they also warn that the outlook remains uncertain because of the factory orders. The factory orders actually it declined, and the ECB right now it prepares for also an interest hike potential or probability, high probability for that. So for the Euro USD, how this will impact this specific article. So the positive news is that because the economy, they perform better than expected. So markets right now think that the central bank might feel confident enough to keep the interest rates high. And at the same time, higher interest rates, usually it makes a currency more attractive to investors. Why? Because it helps the euro price go up. But the catch here is this one, because future demand, factory orders, meaning the local or the domestic goods from Germany or for that specific region, is looking weak. So the markets right now, they are not convinced the growth will last. So it could be a shorter term. And this fear driven or worries right now, it keeps right now the euro from rising very much. So that is hampering right now the pair to go up, because right now it's still on 1.15. And again, we target at least by end of the month at least near 1.17 or 1.16 level, because from time to time we really see not only the inflation but rather on the side of energy costs would persist. And at the same time, how this article would impact or influence the DAX or the German index. So the positive here is that companies, they produce more goods than expected, which is great for the business. But the catch here is that even though the business is firm right now or is all right, but the investors also, they may worry about the future. So two things are really holding the stock market back. First, there is a slowdown of fear that factory orders are really falling, as I mentioned earlier, which means companies might not have enough work later for the year. And at the same time, the borrowing cost, because the central bank is really expected to raise that interest rate. So this makes right now it's more expensive for companies to borrow money to grow their business, which usually makes investors less likely to buy stocks. And again, for the financial side, they may benefit from it when the interest rates are really high, but we expect as well that there will be higher non-performing loans or NPLs. So that's the impact again of when inflation goes to interest rate and how it affect the economic activity and or the businesses. And let's take a look as well for the China inflation, since we are talking in inflation. So here, so the China's wholesale inflation, it hit high, 4-year high again, due to surging raw material costs from the Iran war and intense demand for AI technology. So the consumer inflation, it remains weak as domestic spending continues to lag behind, constrained by a difficult job market and property sector slump. And while there is strong exports in tech and renewables, there are also driving some growth. They also have warned that the markets here, that they warn that there is a broad-based economic recovery and it still remain fragile. So this is right now the inflation, current situation of the inflation in China. And at the same time, let's go to the US inflation. So here, so this is where we get that specific data as well. So last time, so right now, to just give an update for this one, because the US inflation, it's really we're expecting around 4.2 annual rate. So it's going to be the highest level since 2023. And again, while energy cost is really coming from the war, or the catalyst is the Iran war, and as a major factor for this one, they are also looking right now if there's an increased worry that the inflation is spreading into other areas of the economy. So that means they have this caution that if these numbers comes in higher than expected, which we call it surprise as well, so the markets should prepare for continued volatility as inflation provides stickier than anticipated. And you can really see that because when you look as well on the side of the consumer staple stocks, particularly in food and beverage, there is a persistent, because no matter what, it's really the energy and the oil as well are collaborating through the surge of these prices. Now, let's take a look if the 4.2% is a problem. Because again, if you are trading in the Forex as well, since you are pegged in the majors like the USD, so when it misses the goal, it means when the Federal Reserve, it aims usually, their target is 2% inflation target. But at 4.2%, so let me show first the logics. Here. So just think about the previous or the historical data from 2.7, 2.43, and then it's 4.2. That's going to be the forecast. Inflation here is more than double that the goal, because again, their goal is 2%. So it forces the Fed to keep interest rates high just to fight the inflation. So that is the likelihood or the probability. And at the same time, the energy shocks because of this 4.2, if this is a problem, the closure of, because it remains right now on the Strait of Hormuz is being blocked, it already sent energy prices and it's still soaring. That means it's still persistent. And since energy is used to produce almost everything and it acts as a hidden tax that slows down the entire economy. And for the slower growth, including the OECD, they provide as well insight on that. So they as well, we expect this situation to drag down US economic growth or the GDP to about 2.0% this year. So that those were the forecasts on the side. And because of these stubborn prices that we keep on looking, so beyond just the energy, factors like a tight job market is also keeping the prices generally higher. So it's really making it difficult for inflation to return to the Fed's comfort zone, which is around 2% target. So that is likely the scenario that we anticipate, because we were already provided the previous figures before from different economic indicators. And what is the macroeconomic impact for this one? Of course, there is a lost purchasing power. So again, higher prices, it means your money, it doesn't go that as far, and real wages are really actually falling. And there is a stock on the interest rates because the inflation, it remains high. The Fed right now, it seems on the side of like being trapped because they cannot lower or slash the interest rates to stimulate the economy without risking even higher inflation. And for the from time to time, which the market does not like, which is the uncertainty. So the markets may not like this 4.2% level. So it creates the instability that the stock and the bond markets, again, it's not very attractive to the equities having those as the future direction of the interest rates remain uncertain. Again, for inflation, mostly the sector that is benefiting from this one are would be the food and beverage, which is when we look on the stocks, it's the consumer staples. Will inflation be the key driver for the WTI's next move? So let's focus right now on inflation. Yes. Sorry, what the? Okay. So the US, so let's take a look right now for the inflation. Again, let's go back here. The US inflation, again, 4.2. We always keep talking about this inflation. At the same time, the oil. So these two factors right now are really surging the market up and down, plus the uncertainty from the Middle East. Now, marking this third consecutive monthly acceleration driven by this surge in gas prices and the conflict in Iran. So despite this headline increase, core inflation is projected to see only a modest rise of 2.9%. Again, it's on the 2.9% we're focusing, but in a broader way, from over a year, it's 4.2. So just think about how these, how if you're going to recalibrate your financial sheet right now, where are we going? Do you think, for example, in the financial industry, do I expect more non-performing loans right now? And having these strong jobs that keep pushing as well to the inflation, of course, there is a consumer spending right now, but again, what would be the result for the interest rate? So again, we keep talking about this inflation, but what does it actually do to your stock portfolio? So while a little bit of inflation, it can be a sign of a growing economy, high or out of control, because right now we see not only from the side of US, but in other regions as well, it's becoming out of control, and it is usually negative news for the equities. Again, expectations over the long run extension of the Fed rate and more volatility relevant to rates. So a surge in oil prices right now, it acts as the stagflationary shock. Yet its overall impact on global growth, it remains right now relatively contained. So again, that's how we view in terms of the inflation, even until end of the year, because we don't have a specific resolution yet that is being provided. It's always uncertain. And again, from time to time, the increase for the demand as well for the energy is also, it will remain constant. So other than this, we have seen this week the impact of the AI, because AI is also another factor that contributes to the inflationary pressure, because the firms, they deploy significant capital into foundational infrastructure such as the data centers, for example. They are specialized semiconductors and energy capacity ahead of the realization that there is a widespread productivity gains. So we are currently in a transitional period. That's what we see at the moment. A transitional period of capital-intensive deployment. That means the economy is absorbing the elevated cost of developing these systems while anticipating that future operational efficiencies, it will eventually exert downward pressure on prices. So when inflation hits, a company cost for those raw materials, energy, and wages, it will all go up. Again, just to have that, because back then, when inflation comes, we expect it's either the Fed or the central banks will slash. But right now, it's totally different because of the war. And we have a damaged infrastructure from the Middle East that is catering for the supply of energy. So we expect interest rate to remain over the long run. Now, going back to that, again, when inflation hits, a company's cost for raw materials and energy and wages, it all goes up. And if a company cannot pass those costs, for example, to a consumer without losing sales, their profit margins, it really shrink. So when profits drop, stock prices almost always follow. And it's not just the companies, it's just the customers as well. So passing on those costs directly to the consumer. So when people, of course, or the consumers, they spend more on essentials like the groceries, for example, those goods and the rentals as well, they have less disposable income. And that's what we always also track, the disposable income to spend on discretionary items like the electronics, travel, and dining out. So that drop in consumer spending that we check during inflation, it hits the corporate revenue or profits right where it hurts. So this is the big one. How does the market fight high inflation? By hiking interest rates. So as we have a couple of times mentioned before about discussed that when the Fed, they raise rates just to cool down inflation, they make borrowing more expensive and make bonds look more attractive than stocks. And that's what's happening when there is an expectation of the rates. They shift into the bonds. And to summarize this, inflation, it creates a triple threat as well. It really grabbing the income company or corporate profits, the margins, and also it discourage consumer spending because it's very expensive. Everything is very expensive. And you're going to borrow that idea as well. It's also expensive. So higher inflation plus expensive to borrow as well. So it forces the Fed to implement policies that make right now the stocks less attractive. And that's the chain reaction. So that is why for the majority of the market, high inflation is a major bearish signal. And with the shrinking margins, input costs like the labor and the materials, they rise faster than sale prices. There's a weakened demand as well. Consumers have less money to spend on non-essential goods. For the policy pressure, it triggers interest rate hikes, which lowers the valuation of future corporate earnings. So if you are trading, for example, in the foreign exchange and looking on this specific data, so inflation is rising, but the central bank acts aggressively, which is what we are anticipating across all the central banks. So the signal here, the policy control is being maintained, and likely what would be the reaction of that specific local currency? Bullish or currency strengthens, it supports. But if the inflation is rising and the central bank is passive or behind the curve, and there is a loss of purchasing power and economic instability, likely the currency becomes bearish or the currency weakens. And if the inflation is high relative to the trading partners, depending on the country you're looking at, for example, your local currency is 5% inflation and the other one is 8%. So there is a real value erosion for this one. We expect as well the bearish, there is a currency weakening as well. Because back then, we are not looking for sticky inflation or stagnation or stagflation. Right now, that is, we are keep looking from time to time since the beginning of the closure of the Strait of Hormuz. So that's what we have to at least prevent the stagflation. So again, if your real rate is higher than other countries, markets will keep buying your currency because your returns are more attractive even if your inflation is high. If your real rate is lower, then investors will pull their money out and it causes your currency to drop. So let's take a look as well for the US dollar. Again, this is the chart for the US dollar. Back then in March, it was on this region, and again, it's really that was the concrete ceiling, and it also pushed again after 2 months to 100 level. So if this again having this concrete ceiling at 100 level, it prevented to become even more bullish last March. But at this time, because we are anticipating the interest rate, would it push this 99 level to beyond 100, 540 level? That's why if you are trading, particular in the commodities, you have to check as well the dollar index. So for this inflation, US dollar index right now is the most sensitive because it is the metric for the interest rates for this time. The connection for this one, when CPI is high, again, the Fed usually increase rates and slow things down, the economic activity. Higher rates makes the dollar more attractive to international investors looking for better returns, and it pushes the value of the dollar, and the USD or DXY, it goes up. But for the side, for example, you are on the side of commodities like the precious metals, the gold, again, the higher that it will increase for the dollar, it will become expensive for gold. So the demand for the gold, it would lower because gold is always priced in USD. And the global comparison for this one, because the DXY, it tracks the dollar against as well for the currencies, other currencies. Inflation data, it forces the Fed to change its path. It could be a hawkish by raising interest rates or by cutting them. But again, we don't expect at this time to slash interest rate because, again, because of the inflation. Back then, that was the traditional or the classic that we look at, slashing or maintain. But right now, it's maintaining to increasing. That's what happened to the trend since this war began this year. So that, again, that scenario, it often creates, there's a gap between the US is doing and what other countries like Japan or those in the EU region, markets react this difference immediately, and it causes as well the dollar index to move sharply. And for the equities, from time to time, the S&P 500, for example, so let's take a look for the chart as well for the S&P 500. So last time, it really went rally, bullish. Same thing with the NASDAQ and at the same time, Dow Jones. So this is the 30-minute chart as well for the S&P 500. And why I'm looking on the 30-minute chart? Because we expect, to be exact, there is volatility once the data has been released, even if there is a confirmation. Why? We are looking on the equity side. And for the equities, for those stock prices, some they have already projected their prices from the profits, the revenues, net income, and so on. So that's how when you trade, when it comes to trading during the CPI data and interest rate, look always on a lower time frame to see not only the volatility, but at the same time, because when you look on a higher time frame like the daily, the weekly, it's the trading range. But because you want to see the market, where it's going, where it's heading, for example, I'm using right now the Bollinger Band, is it going to on a bearish or bullish? So much better to, if you are very conservative on your part, look on a lower time frame and at least pause at least 5 to 10 minutes to digest the entire data, because there is a heavy volatility from time to time. There are also gaps. So lower time frame, it will help you to designate your entry points and exit points as well if you on the side of short-end trading. Now again, to explain further the impact of inflation for the S&P 500 and the NASDAQ, they are primarily affected by this, by the CPI. So right now, corporate discount rates, that when you look on the equities, and the borrowing costs, that's what we track when we are on the side of the equities, including the Russell 2000 index. So they are uniquely vulnerable as well due to the reliance of these small cap companies on variable rate debt. That means the bond indices as well, they serve as the most sensitive gauge for this inflation direct impact on purchasing power and yields. So again, this is the S&P 500 on a lower time frame as well. So that's the time when you trade with high impact economic indicators, much on the side, look on a lower time frame. If you can gauge as well on the 1 to 2 minutes, because you will be able to see the reaction of the markets on a lower time frame, and at the same time the direction. So have they already factored in, since they expect then there is a neutrality from time to time, and then you will be able to see which prices that you are going to enter, sorry. Now let's take a look as well from the IMF, since we are also looking on the side in the Europe. So here, just to give you update as well from the IMF. So the Europe right now, based from this, Europe is currently on the compounding economic shocks, and includes right now the latest crisis in the Middle East, which is really stunted growth and widened the prosperity gap compared to the US and China. So to combat this fiscal vulnerability and stagnation in Europe, the IMF right now, they are urging the Europe to have this instant or urgent complete its fragmented single market just to support productivity and growth. And the region, finally, they must have this discipline or adopt this disciplined budget neutral fiscal policies, and particularly regarding the necessary increase in defense spending to ensure this economic resilience. So if you are watching on the European markets, here is what tougher reality means for your portfolio across different asset classes based from on this one. So European equities, they face the volatility. I mentioned a couple of times when it comes to German index and manufacturing orders as well in Germany. And with performing favors right now that capitalize on deeper market integration. So we see a unified defense procurement over those hampered national fragmentation. So that means we also look on the sovereign fixed income. They are facing right now a downward pressure because of a rising debt to the GDP ratios, that it could have a necessity higher risk premiums, wherein euro remains sensitive to the region's growth gap. It's very sensitive. You can see, again, it's 1.15 right now. Last time, it was 1.16. Back then, it was 1.17. Every time there is energy costs, and they really are being squeezed and being pressured downward. So it likely, the weakness, unless there is a structural reforms to the single market to materialize this one successfully. And even though markets right now, they focus on the demand, so it's really on the supply, or the dwindling supply of swell of gold and silver from mines is also a reason why prices have been rising. So that's what we are there looking at. And data shows that gold mining as well has a dominant effect on both metals. So it accounts as well for a large portion of the price swing. So since the recycled gold and silver only sold when prices are already high, but they don't actually push the prices down. So therefore, tracking primary mining output, again, it's the mining side, is the most effective way to understand where these markets are really heading or directed. So again, that's how we look as well for the markets right now. And for the Fed Reserve, they have announced that they have a release of results for the 2026 big bank stress. So let's take a look as well on that report. So yes, we also have before this one, we have the Fed Reserve had announced they will have a results of 2026 big bank stress test on June 24. And the release of Federal Reserve Bank stress test results, typically it acts as a source of information that will help the investors right now differentiate between stronger and more vulnerable financial institutions. So let me give you that report for this one. So here, this is what I'm saying. So what is the impact of this one? Because again, since we mentioned as well the interest rates in the financial industry. So how would this impact as well the sectors? So for the equities, for the banks right now, traders or the markets, they closely monitor the data just to identify the strongest performers, which it could lead as well to rapid price swings for banks that appear it less prepared for a crisis. It happened before. That's why after if there is when we look at the same time of the non-performing loans, that's when we see as well what could be the credit rating for that specific region. That's why this is also crucial for us if you are focusing as well on another indicator, which is the credit rating. Next, for the fixed income, these results, the impact of this one, the results, they serve as right now as a metric for credit health. So potentially, it causes right now the markets to demand higher returns on debt tied to sectors like the commercial real estate if findings really hidden vulnerabilities. So at the same time, it also talks about the mortgage, the impact as well during this period. And for the derivatives as well, should the report indicate unexpected systematic weakness? So again, market participants, they really open flock to options and volatility hedges, and it drives right now the VIX. So this is the report that we look at the Fed to release the 2026 bank stress test, and that will be on June 24. So again, I mentioned mortgage as well for the real estate. So investors, they use the Fed's projections on property market stress to gauge the stability of REITs with negative findings, and it also gives a cooling sentiment toward real estate-linked investments. Now, these are highlights for the reports for today. Now, let's take a look as well, going back to the WTI. So here, since we see this one, this is a lower time frame as well. So what is the key factor for this one? So the key factor, again, it's really what happened to the war last time. So when trading WTI, here with the CPI report, the most critical factor that we have to grasp is that the data serves as a proxy for future interest rate policy, and it directly drives the strength of the US dollar. So WTI is really seen drifting lower due to the easing tensions as a key factor. Last time, it went up, and then right now, because of the easing tensions, it really drifts lower. So again, why I'm looking at lower time frame, it's because of the volatility that I'm expecting, providing that there was already an EIA crude oil inventories, and at the same time when there is also new update from the Baker Hughes. So the resistance, I'm on the 30-minute chart, the higher that I could look at based from the lower time frame is 93.4. And the lowest, this one, based from the 30 minutes chart that I'm looking at, is 84.7999. That's the lowest. And the first resistance that I have is based from the 4-hour chart, it's 89.973. I have different time frames looking at because the number of frequencies that it tries to break that price level. That's why I'm looking on a lower time frame, particularly when you check from time to time the CPI report. And also I also look back on the time that the previous trading or when CPI was released last time. That's why I look on at least 30-minute chart, 2-hour chart, and 4-hour chart for the trading of the WTI. Now, you can see that there is also drifting right now. So it's really on a sluggish mode right now for the WTI based from the 30-minute chart. So trading high impact news like the CPI, it's really like switching from trying to predict the market sensitivity by simply surviving the volatility, because again, this is a high impact economic data. So the rules for this one, so we do not chase that spike. We have to at least do not at least there is a 1 minute to 5 minutes. Others they do 5 to 15 minutes to digest the data. It's because at least stay out for at least 1 minute, and the market, because again the market is really too chaotic when you have this news, unless you can really do some for this one, if you can really predict the market directly and you can have that entry trade price. But again, the market is too chaotic. And not only that, again, during the time that this could be released, there could be also a factor that could also spike the prices. Like, for example, the tensions in the Middle East. So back then, you would be able to track without those tension. But this time, because the market is also sensitive to the tension that is ongoing in the Middle East, plus the CPI data. So given that factor, it's much better not to chase that spike. And the spreads, you can see as well, it's too wide. So wait at least 5 or 10 minutes. That's what a specific real direction to emerge. And at the same time, the size down. So much better reduce your position size. So never risk more than at least 1.5% of your account on a single trade. And we also have to take a look from time to time, because you are a trader for the WTI, check as well for the DXY. Right now, the DXY, it's really around 99 to 100. And back then, if it spikes right now, the news, for example, the CPI right now, and the DXY, it spikes, usually the oil falls. Since we have this sticky inflation again, plus that, again, that uncertainty in the Middle East, we are looking is the inventories. That's why from time to time, we also check the EIA inventories when you're trading for this specific commodity. But the idea that the US dollar and oil, they are always move in opposite directions, it could also be a misconception, because the relationship, it frequently breaks down major events like the CPI releases. So when both fall simultaneously, that it usually causes external factors, which is the risk of sentiment. And right now, again, not only that, the supply side shocks, which is we know that the US is an energy export, or the algorithmic trading, again, because we also include the algorithmic trading, because of the high frequency traps overrides the currency's influence. So markets should really prioritize all specific fundamentals rather than assuming the dollar will consistently act as a mirror for the commodity price movement. That's why from time to time, really check. You will see the spike of the WTI, how these react to the tension, and at the same time, how also, for example, the gold as well, and the DXY. From that is we have to look at the same time. And for the technical indicators, we have the ATR, or the average true range. So it is used as well to adjust stop loss with the multiplier. And at the same time, the Bollinger Bands, it helps you to visualize periods of sudden volatility expansion, and it signals when to avoid mean reversion trades. And we also since we use the Bollinger Bands to confirm as well the breakout, that would be also good to use the volume profile, because it acts as support and resistance magnets as well. And for the market structure, specifically the pre-event consolidation range, so it provides as well critical boundaries for identifying breakout and retest opportunities. So we use a wider stop based on the ATR, so that you don't get stopped out by noise. So this is the 30-minute, and this is the 1 hour chart. So let's take a look what happened last time in May 12. Here, May. So here, what happened. That's why it's really, I really track this one in a lower time frame. just to confirm, are these prices very significant for me? Because when you trade high volatility, at least you know how many times that price touch or broke, and at the same time you also have the Fibonacci as well. So Bollinger Bands again, this is what happened last May 12. So that was the time of CPI release on the 1-hour chart, and you can see the price movements at the same time. And Bollinger Bands again, these are the curve that you see. So it's a volatility market to gauge. And narrow bands means it suggests a quiet low volatility period. And the price touches as well. Is it the outer bands or the lower bands? So outer bands, it warns that the market might be stretched or overextended, and it signals right now a strong directional move for the key support resistance level, which I provided earlier. So here wherein you step in to stop upward movement. So here I said 93.465. That's the second resistance I'm looking right now. And for the support zone, I have the 85. So these are the price floors where markets participants have historically stepped in to prevent further drops. So for the RSI, earlier it was around 40.58. So that means it's still considered neutral, though it also leans slightly bearish since it's really on the near midpoint of the 50. And we also have the stochastic oscillators. And this right now, it tells potential reversals by comparing the price close against its recent range. So with both lines right now, it's sloping downward, and it suggests right now the short-term momentum is currently focused on the downside. So here. And the accumulation distribution as well, it correlates with the volume price. So the sharp downtrend here is very significant because it confirms the price drop or the recent price drop. So that's it for today, and I hope I was able to provide you with market insight about this inflation report. Again, we just take a look on how this 4.2 would be very significant, not, because it's really very important to take a look at that 4.2% because this is very high at the moment. Just think about, we are on the second year, and as we go on the next quarter, will this 4.2 will be very will make the markets vulnerable right now? And at the same time, on top of that, if the energy will be persistent in the price increase, so how do we expect as well? You can already gauge what would be the next interest, not only interest rate, but the inflation over the next coming months. So we have not already as well talked about the climate change. Back then, we look on the, for example, on the agricultural side or the commodities affecting the inflation. But right now, it's more on the side of the damaged infrastructure connecting our chain reaction right now to the inflation. So that's it for today, and I hope I was able to provide you with guidelines for the WTI and the same time on the inflation rate. So now you can want to join, just trade or scan our the code. So register for our dashboard and start tracking the markets. And you can also join our Discord. The link is on the description box below. You can also check our copy trading. So here we have the trading cup. So you can really mirror their strategies while keeping technical analysis more straightforward and easy to understand. Again, markets are moving fast, so stick to the plan and let's secure our lead and make it happen. So thank you for joining today, and I hope today's session provided you with some actionable insights. Have no fear, Ira is here all is well, and thank you for watching. See you on the next live session.